Tech stocks always seem to steal the spotlight. Whether it's a groundbreaking AI breakthrough, a new gadget launch, or even just rumors about the next big thing, the tech industry constantly captures our attention. It's the industry where innovation meets ambition, and every headline feels like a glimpse into the future. Naturally, this makes tech stocks one of the most talked about investment options. Investors are always on the lookout for news, trends, and inspiration to pour more money into this ever-evolving sector. But here's the catch. Tech stocks are also among the most expensive investments out there. Despite their high valuations, people keep lining up to buy them. What makes tech stocks so special? Why are we willing to pay such a premium for them? This is so expensive. Before we go any further talking about the tech industry, it is important to understand the behavior of the stock market. When it comes to stock price movements, very often the financial performance of stocks is the first thing that comes to mind. But then, financial performance is backward-looking. It reflects how a company has performed in the past, and the market prices that information into the stock to determine a fair valuation. While this is an important part of the equation, it's only the starting point. Share price movement is more than just a reflection of past performance. Next, there's market sentiment, which often plays a bigger role than people realize. Market sentiment is about emotions, expectations, and the collective mindset of investors. A great example of this was in early 2024, when the tech sector rallied after the Federal Reserve hinted at potential rate cuts later in the year. Even though there wasn't a concrete policy change yet, the market surged because investors believed lower interest rates would make tech stocks more attractive, particularly for growth companies. This wasn't about current earnings or past results. It was pure sentiment driving the market. And then, the most critical factor, the forward-looking nature of the stock market. Unlike financial performance or even market sentiment, this is where the real action happens. The stock market is always looking ahead, reacting to new information that could impact a company's future. Investors don't just ask, what has the company done? They ask, what will this company do next? It's why tech stocks in particular tend to see such dramatic price swings. When new information, like a breakthrough in AI or a potential supply chain disruption, hits the market, investors quickly reassess whether the stock's future looks brighter or dimmer. This anticipation of what's to come is the heartbeat of stock price movements and explains why tech stocks command such high valuations. They are not just about the now, they are about what could be. What makes the tech industry so special is how fast it grows and changes. Most industries move slowly, one step at a time, but tech grows like a rocket, getting better and faster every single year. This happens because of something called Moore's Law. Moore's Law was an idea from a smart guy named Gordon Moore in 1965. He said that computer chips would get twice as powerful every 2 years while getting cheaper to make. And guess what? He was right. For decades, technology has followed this rule, giving us faster and better computers, phones, and gadgets all the time. Take Intel for example. In the 1990s and 2000s, Intel made new computer chips that were way better than the ones before. People and companies rushed to buy these faster computers, and Intel's business exploded. Its stock price shot up because everyone wanted the newest and best technology. Then, there's NVIDIA. In the 2020s, NVIDIA became super important for things like artificial intelligence and self-driving cars. Their special computer chips, called GPUs, got better and better, just like Moore's Law predicted. This made their stock price go through the roof in 2023 as everyone wanted their chips to power the future of AI. In recent years, some breakthroughs in technology have gone beyond what Moore's Law predicted. For example, look at Apple's M series chips used in their Macs. When Apple launched the M1 chips in 2020, it was a game changer. Not only it was faster than previous Intel chips, but it was also super energy efficient. Then, in less than 2 years, Apple released the M2 chips, which was 35% faster than the M1. That's even faster growth than what Moore's Law would expect. Let's talk about AI and NVIDIA. In the past, Moore's Law focused mostly on how many transistors you could fit on a chip, but today, tech companies are finding smarter ways to design chips. NVIDIA's GPUs, which are critical for AI, are improving performance much faster than doubling every 2 years. In 2023, NVIDIA announced chips that were up to 10 times faster for AI tasks compared to their previous versions. And here's another example. quantum computing. This technology is in its early stages, but it's growing so fast that it might not follow Moore's law at all. Quantum computers can solve problems in minutes that would take traditional computers thousands of years. If this keeps growing, we are looking at a future where Moore's law feels slow by comparison. So while Moore's law has guided tech growth for decades, today's innovations might actually outpace it. Companies like Apple, Nvidia, and those working on quantum computing are pushing the limit and what's possible, creating technology that's not just faster but completely transforms the game. And that's why the tech industry is so exciting. It keeps surprising us. In the tech world, people love to swap out their old gadgets for the latest models. Think about how often you and your friends get new smartphones, laptops, or gaming consoles. This constant upgrading is called the replacement cycle, and it keeps the tech industry buzzing with activity. But it's not just individuals who are part of this cycle. Businesses also regularly update their technology. Companies often replace their computers, servers, and other equipment every few years to stay efficient and secure. For example, many organizations use servers for 5 or more years, with about 32% keeping them for 7 years or more. However, holding on to old hardwares for too long can lead up to problems like security risks and reduced reliability. When new technologies emerge, like the future arrival of 6G networks, both individuals and businesses will need to upgrade their devices to take advantage of faster speed and better connectivity. This means buying new smartphones, computers, and other gadgets that can handle the advanced technology. A great example of this is the shift from 4G to 5G. Telco companies worldwide have invested heavily in building 5G networks. Between 2022 and 2025, it's expected that more than $600 billion will be spent on 5G infrastructure globally. This massive investment shows how significant these technology upgrades are in the industry. The replacement cycles, whether by individuals or corporations, drive the tech industry's rapid growth. They ensure that companies continue to innovate, develop new products, and improve services to meet the ever-evolving demands of consumers and businesses. Indirectly, they are also creating shareholder value when they generate more profits from these sales, and that drives the stocks higher. Now that we know tech stocks are generally expensive, let's break it down further to fully understand where investors put their money when investing in tech companies. The tech industry is like a well-organized factory, with each step of the process adding value to bring cutting-edge technology to life. At the very top of this chain sits the fabrication process, where raw silicon is transformed into tiny complex semiconductor chips. This happens in highly advanced facilities called foundries, operated by companies like TSMC and Samsung Foundry. These companies are the giants of the upstream segment, producing the chips that power everything from smartphones to supercomputers. What makes this process truly mind-blowing is the incredible precision required to create these chips. Think about this. The transistors inside these chips are so tiny that millions of them can fit into a head of a pin. In fact, some of the most advanced chips today use transistors sized as small as 2 nanometers. To put that into perspective, a single human hair is about 50,000 nanometers wide. Why is this precision so important? Because even the tiniest imperfection, a speck of dust or a microscopic misalignment, can render the entire chip useless. That's why these facilities are some of the most important places on Earth, with clean rooms up to 10,000 times cleaner than a hospital operating room. Workers wear specialized suits, and the air is constantly filtered to ensure not a single particle disrupts the manufacturing process. The sophistication doesn't end there. These chips are built layer by layer, with each layer requiring lasers to etch patterns into the silicon at atomic level accuracy. This precision ensures that the billions of transistors on the chip can work together seamlessly to process data at lightning speed. It's this level of detail and perfection that makes the tech industry more sophisticated than most people realize. That's why upstream tech companies are so expensive. But once the chips are fabricated, the journey doesn't end there. Raw chips straight from the foundry can't just be shipped to consumers. They need to go through an essential process to be tested, assembled, and packaged into usable components. That's where outsourced semiconductor assembly and testing comes into play, a critical step in semiconductor value chain. And here's where Malaysia, particularly Penang, emerges as a key player on the global stage. OSAT companies in Malaysia specialize in transforming raw chips into fully functional components. These companies handle the vital task of testing, assembling, and packaging chips, ensuring they meet the highest quality and performance standards. Malaysia's role is so significant that the country contributes approximately 13% of the world's semiconductor assembly and testing services. This critical contribution to the tech value chain explains why Penang has earned its nickname, the Silicon Valley of the East. In Penang, a state famous for its robust electrical and electronic ecosystem, OSAT companies operate in facilities equipped with cutting-edge technology. These companies test chips under simulated real-world conditions, weeding out defects to ensure reliability. Imagine this, a single defect could compromise an entire device, from a smartphone to a satellite system. That's why the stakes are so high and the precision is unparalleled. OSAT companies in Malaysia also take on the highly complicated task of assembling chips, stacking layers with microscopic precision to prepare them for integration into the final products. Their expertise in advanced packaging ensures chips are durable, efficient, and ready for global markets. From the OSAT stage, these polished and packaged chips move downstream to be integrated into high-performance products and systems. Companies like Apple, Tesla, and Nvidia rely on these semiconductors for their cutting-edge devices. For example, Apple uses advanced processors for iPhones and Macs, while Tesla incorporates chips from Penang-based OSAT players into its electric vehicles. Nvidia leverages these semiconductors to power AI supercomputers and advanced gaming devices. This downstream segment represents the final step in a remarkable journey that starts with raw silicon and ends with the sophisticated devices and ecosystem we use daily. And how Malaysian tech companies play a role in this is to act as a crucial bridge between the upstream fabrication processes and the downstream innovations, driving global technology forward. To sum things up, the value chain of the tech industry is a story of innovation, precision, and relentless growth. It is all these factors that make tech stocks so exciting and so expensive. It starts with exponential growth, fueled by Moore's Law, the principle that computing power doubles every 2 years, driving constant innovation. This growth is amplified by the replacement cycle, where both individuals and corporations regularly upgrade devices, and new technologies like 5G and AI demand entirely new infrastructure. Then comes the complexity of the value chain, from the upstream fabrication process, where foundries like TSMC craft chips at atomic level precision, to OSAT companies like those in Malaysia, which test, assemble, and package these chips into ready-to-use components. The journey doesn't stop until these semiconductors power the world's most advanced devices, creating value every step of the way. What makes the tech industry so unique is how it transforms complexity into opportunity. Investors are drawn into this space because each layer, from fabrication to OSAT to downstream integration, generates immense value, building on the innovation of the previous stage. This is how the tech sector has created massive shareholders' value, making it one of the most compelling industries for investment today. So far, I've been explaining why tech stocks often come with hefty price tags. But let's pause for a moment. Just because tech stocks are expensive doesn't mean every expensive tech stock is worth the price. Some companies market themselves as the next big thing, with groundbreaking technologies they claim the world can't live without. They position themselves as the must-have stock for every investor and consumer. But history tells us to be careful with this company. Take BlackBerry, for example. Once hailed as the king of smartphones, BlackBerry dominated the market in the 2000s. But the company failed to adapt to the rise of touchscreen technology and app-driven ecosystems led by Apple and Google. Despite all the initial hype and investor excitement, its inability to innovate caused its stock price to plummet, leaving many investors with heavy losses. Or look at GoPro, the action camera company that promised to revolutionize how we capture and share life's moment. When GoPro went public, its stock skyrocketed to over $93 per share, fueled by the narrative of being a unique tech disruptor. But when competition increased and the market for action cameras didn't expand as expected, GoPro's stock price fell dramatically, eventually trading below $10. These examples show that not all hyped-up tech companies can deliver on their promises. When consuming news, analyst reports, or other sources of information, ask yourself, does this technology truly have the potential to trigger a shift in demand? Does it make sense in the context of the world today? If the answers don't convince you, chances are you are right to doubt. History is full of examples of hyped-up tech stocks that fail to deliver, leaving investors with hefty losses. Staying grounded in facts and trends rather than getting swept away by the hype is the key to avoiding these traps. In my next video, I'm going to pivot to talk about something that's closely tied to technology but doesn't command the same kind of valuation as tech stocks, the automotive industry. With the rise of technology, the shift to EV is becoming very real. More and more money is flowing from traditional automakers to EV-focused companies. This trend has shaken up the auto industry to the point where established names like Nissan are struggling, reportedly nearing bankruptcy and considering a merger with Honda to stay afloat. In Malaysia, we have seen the impact of this shift as well. Tanjong Motors, the distributor of Nissan vehicles, has experienced a dramatic fall in its share price. But here's the question: at this price level, is it still expensive or is there an opportunity? Stay tuned as we dive into the fascinating intersection of technology and traditional industries. The answers might surprise you.